I would like to acknowledge the traditional owners and custodians of country throughout Australia and their continuing connection to land, waters, and culture. And I pay my respects to the elders past, present, and emerging, and extend that respect to Aboriginal and Torres Strait Islanders who are present here today. Second, so I think I've muted most of the participants that were incoming. During the presentation, please mute your audio. We will have some Q&A breaks during the presentation, and I'll moderate that. So if you have a question, please either use the raise your hand function or write in the chat that you have a question, and I'll moderate. And of course, if you have any urgent clarification question, please don't hesitate to use your mic and shout. Then it's a pleasure to introduce Dr. George Kutner. George is a senior research fellow at UNSW and CEPAR. He's also a fellow at the Global Labour Organization, as well as a mid-committee member of the steering committee for the development of the Overlapping Generations for Australia model. He's also a research associate at the Center for Applied Macroeconomic Analysis at ANU. His research interests are pension economics and the economics of population aging research and applied equilibrium modeling. And I'm very much looking forward to this talk, not only because I'm a German living in Australia. George, the floor is yours.
Thank you, Inka, and good morning, everyone. Good afternoon, sorry, it's still morning here, actually. Good afternoon, everyone, and thank you for joining in. This paper, entitled Wealth and Homeownership in Germany and Australia, the Role of Tax and Retirement Income Policy, is a joint work with Hans Feher from University of Würzburg, Germany. He's the expert on tax and retirement income policy in Germany, and has been working with same type of model that we developed and used for the analysis in this paper over the last 3 decades. And also Maurice Hoffman, who was involved in early stages of the model development. So I should also say that this project has been around for some time, and I have to thank to the COVID crisis for actually completing it. So we now have a working paper that I will make available at CEPAR website later this week. So for those interested in details, please have a look at the paper. I should also say that I've been having frequently problems with my internet connection. So in case my face freezes at your screen, so don't panic. It often comes back very quickly. So, all right, and as Inka said, I plan to have small breaks after each section, so I pause a little bit, and that's when you can ask questions. So let's get now into the paper. So here's the motivation. I mean, the motivation is a bit broader than just sort of looking at Germany and Australia, and really it's to looking at developed countries and observing that home ownership and wealth level differs quite greatly. And if you look at, in particular, Germany and Australia, what's interesting is that the two countries have similar incomes. So here, for example, you can see GDP per capita, household disposable income, or even when you look at average labor earnings, they're very similar in the two countries. But if you look at home ownership ratio, in Germany, 44% compared to almost 70% in Australia. And even more, if you look at average household net worth, in Australia, in 2018, it exceeded $1 million. So Australia is, in fact, one of the richest countries, looking at sort of the net worth. In Germany, that figure is significantly smaller. Okay, so our objective here is to quantify the extent to which these differences in home ownership and asset levels are induced by national tax and transfer policies. And in particular, what we do in the paper, we look at long-run steady-state implications for the housing market, macroeconomic aggregates, including the GDP, capital stock, government budget, and also welfare of future generations. In addition, we also provide decomposition of the results in order to isolate the impact of income taxation, means-tested age pension, and funded superannuation. Our approach is to develop general equilibrium model with overlapping generations. And what's important is that the model features tenure choice of households. And in particular, we're looking at the main tenure that individuals and households make. And that is whether to buy a house and live in it or whether to rent. And it's a stochastic model, so the household face labor income and lifespan uncertainty. Importantly, the model, the benchmark model, is calibrated to Germany with model equivalent details of their unfunded public pensions and very low taxation of capital income. So we start with this German benchmark model, and then what we do, we introduce Australian policy only, okay, into this German framework, and we do that sequentially in the following 5 simulations. So the first one is to eliminate public pensions in Germany, and that is also to eliminate the payroll tax funding. Second is to add eliminations of German capital income taxation, and then we start introducing the Australian system. So we start with Australian income tax system, then we introduce the Australia's non-contributory means tested age pension, and finally we introduce Australia's funded superannuation. And really the main objective is to compare this German benchmark model with the German policy with this 5th simulation, and to see what happens to the home ownership rate and wealth, and also other variables. In terms of related literature, over the last decade, there's been a lot of literature written that applied life cycle model to study interactions between tenure choice and public policies, and I listed some. I want to spend a little bit of time on those close to our paper. So Chen, 2010, for example, already established close connection between social security and housing market. And then there was a paper by Stanley Cho at the University of New South Wales and Eric Hussain, published in 2013. And they look at sort of this owner-occupied housing extension from the asset testing of Australia's age pension. Now, our objective is a bit broader than that. So our objective is to compare, the different income tax and pension systems. But we also look at in the sensitivity analysis on this owner-occupied exemptions and how sort of that changes the outcome. So we provide some results to this. Now, I would also say that sort of additional contribution that we provide in the paper is that we show in detail how the model is calibrated and what is required, what adjustments are required to national accounts to account for sort of housing in this type of models. So I would encourage people to look at actually how this is done, because many people here, they just describe very briefly what's required, but it's never explained into details, which is what we do. Just in case I don't have enough time, here's the preview of main findings. So we found that Australian tax and pension design has dramatic impact on asset levels and home ownership rate. In fact, our model explains about 2/3 of the differentials I showed you on this motivation slide. Now, when looking at the decomposition of the results, we also show that capital income taxation and means testing shift the asset structure towards residential properties. So that's increasing the home ownership rate, whereas superannuation system increases the overall wealth level. So the impact of superannuation system actually on the home ownership is actually quite small. And we look at also the long run welfare implications, and there sort of you can see that under the Australian policy, the welfare on average increases significantly, and not just on average, also across the income distributions. So basically, in a simple language, Australian system performs well, much better than the German system in the long run. Okay, here is outline of the rest of my talk. So I first sort of introduce German-Australian policy in a bit more details, and you will see the differences are significant. Then I briefly introduce the simulation model that we use for the analysis and focus on the household sector and household decisions. Then I provide a little bit of details on calibrations and the initial German benchmark equilibrium and how we compare to the data. Then I talk about the main simulation results, and as mentioned, I also want to spend a little bit of time on this sensitive analysis when we consider alternative reforms to Australian system. Okay, and one of them is sort of including home ownership in the means test. So here is the income tax system in Germany, and I also including here some sort of formulas, the way how this is modeled. So in Germany, and that's sort of similar to what other developed countries have. So they operate so-called dual income tax system, with income tax revenues derived from a progressive tax on labor and pension income and proportional tax on capital income. So this first term is this sort of progressive tax, and this is the second term, which is the proportional tax here on the capital income. So starting with the labor income here, this white tilde is the taxable income. Okay, and here you can see that the taxable income includes the annual labor income reduced by the payroll tax that is subject to some sort of contribution ceiling, twice the average income. So if individual earns more than twice of average income, that payroll tax is kept at that level. And also here you can see that the pension income that people get at older age, 65 and over, is fully taxed here. Now we also applied what's called solidarity surcharge, 5%, and then we applied the progressive tax code. So I show you how that sort of looks and how that compares to the Australian progressive tax code. And in addition, we approximate income splitting method for the couple household. So with the income splitting factor of 1.6. So this basically means that we make an assumption that in our model, 60% of household of the working age are coupled. Okay, so if you had 100%, this would be 2 here instead of 1.6. Okay, so that's basically the income taxation here. Sort of you can see the tax on the investment income. So financial asset minus the mortgage is invested, it earns some interest, and that is taxed at the proportional tax rate. So now this is how sort of the income tax system works in Australia. So in Australia, labor income and capital income are aggregated and taxed under the progressive income tax schedule. So the taxable income here includes the labor income. So this is the mandatory contribution rates. It's after the deduction of mandatory contributions. This is the investment income as before. And here we have the pension income, which is basically the age pension in Australia. So one could think about our model, I would also say, is the program, because basically we have this German benchmark model, and then we can sort of run country factuals when we just change the policy without having different programs. So here, for example, you can see this tau P here is the mandatory contribution rates to superannuation, whereas previously this tau P here in German case is the payroll tax rate. And sort of this is the total income tax revenue. So that's, again, we apply the Australian progressive tax schedule in 2018. And we assume here that the taxes, concessional tax rate, taxes on superannuation, on the contributions and fund investment earnings are just added to the income taxation. But these are the concessional tax rate that you see. So just to show you how the marginal tax rate in Germany and Australia compares here. So here you have the marginal tax rate for different incomes. You can see it's actually not that different. You can see here that up to income of 2.6 times of average income, the marginal tax rate in Germany is lower. Sorry, in Australia is lower than in Germany. Here, this is our $180,000 threshold, and the tax rate goes up to 45%. But not that different, I would say. What is different, however, in the two countries is this taxable income here. Because in Australia, that marginal tax rate is also imposed on the capital. So here is how the public pension operates in Germany. The statutory pension insurance in Germany covers more than 90% of the population. Those who are not covered or not obliged are self-employed. And as in many other countries, it is pay-as-you-go finance. That means that there is a payroll tax imposed on the working age population that is financing the benefits of retirees. In Germany, the payroll tax is levied on labor income up to the contribution ceilings of twice of the average income. Now, what's a bit different in Germany compared to other countries with this type of system is they have what's called earnings points. So these earnings points are accumulated over the working life. So this is basically how they calculate it. So this shows the average earning point. And so this, again, here is this minimum, is this contribution sort of ceiling. But what this basically says that this earning point, the average earning point, when the pension is calculated here, can be between 0 and 2. So someone on average income gets 1 earning point here. So here it would be 1. Someone who earns twice as much than average income across his working life, he would have here 2. Also, you can see that someone who never was in the workforce and earned nothing and didn't contribute in the system gets no pension under this pension insurance scheme. He gets other payments, so I should say. So here is how the pension is calculated. So the difference here is you have these earnings points, and this type of system is called intragenerationally fair. Okay, so there is not much redistribution in the German system. I mean, it's a bit more complex in reality. I mean, you have, for example, things also when people access the pensions before the statutory pension age, there's also additional factor that is less than 1, for example. But here, this is what we model, and this is a very close sort of approximation what's happening in Germany. So here is how the age pension is modeled. It's a very different system here, the public age pension. It's non-contributory, so there's no payroll tax assigned to fund it. It's part of the general budget, government budget. It's needs-based and means-tested. And in terms of the means test, there are 2 tests, the income and asset test, with the highest of the 2 computed reductions, either under the income test or the asset test, then applied. So you have things, you have the maximum benefit that's legislated here. This expression here. So you can see that this maximum benefit here depends on housing. So if this H is equal to 0, which means that the individual is renter, this PH, this maximum pension is a bit higher because of inclusion of rental assistance here. Now, the income test, many of you familiar with this, induces 50% offset if this maximum pension is above, if the income is above the threshold by min, the free income area here. And here you can see that sort of we model, we here calculate the deemed income. It's not actually the actual income from the asset that's derived, but it's the deemed income that applies below thresholds and above thresholds deeming rates. So here we really closely follow the legislation, the way how sort of the pension is modeled. Under the asset test, the maximum pension is reduced at the taper rate of 7.8 cents for every dollar of this. So this AL is the non-superannuation assets, and this AR is the superannuation assets. So some of these above the disregard here. And here again, you can see that the disregard also depends on housing. So this asset disregard is much higher for renters. Okay, so this is what we do in terms of the pension. I should say that I mentioned that sort of we're very detailed in terms of modeling the policy in Germany and Australia. But sort of here you can see that under the income taxation, we tax pension in full here. Those familiar with the details about the pension system in Australia, there's this thing called SAPTO, Senior Australian and Pensioner Tax Offset. And what it does, it basically reduces the tax paid for people age 65 and over, those age eligible for the age pension. I should say that sort of in the program, we have it in, but we set it to 0 because my German co-author was just so frustrated with the complexity of the pension system in Australia that he said that people would not understand it. But importantly, it does not have much impact on the results, I should say. The pensioners already paid quite a low tax. So that's just sort of the clarifications. Now, of course, follow-up project will use Australian-based benchmark model, and in that case, we will have SAPTO model. And so here we have how we model funded superannuation. We assume compulsory superannuation system in our framework with mandatory contributions at the rate of this tau P. Here's the superannuation asset accumulation. So during the accumulation, there are these taxes, concessional taxes on the fund investment earnings and on the contributions. In the drawdown phase, we assume some age-specific drawdown fraction of superannuation from superannuation fund. That's basically just to sort of assume some drawdown of superannuation, and there is no tax on the fund investment earnings. So maybe I pause here, and if there are any questions about these two systems. Inke?
Yeah, so I don't see any questions in the chat. Oh, John has a question, sorry. John?
Hi there. So I was wondering, you have the payroll tax, which funds the social security contributions, which I think of as a tax, on top of the income tax. So if you're looking at the marginal tax rate schedule and you added that in, then presumably the German tax rate schedule will be a lot higher than the Australian. Is that correct?
Yes, that's correct. That's correct, John. And it's important to say this because often what you see in Australia that people criticize that we pay higher marginal tax rate, but our income tax rate do not include any of these payroll taxes that Germans, for example, and in many other countries face. So that's absolutely correct. So that's correct. Okay. So when you look at this schedule, it's just the income tax. Okay, so it's just the income. It's just looking at sort of these marginal tax rates applied to income. That's correct.
What is that? What is that labor? What is the social security rate? Do you know?
Yeah. So I have the calibration slide when we show that, but it's about 18%.
So it would push those rates
significantly higher. That's correct.
Significantly higher than the Australian rates. Yeah. Okay. Thank you.
Yeah.
So George, Bruce Bradbury has written in the chat, SAPTO. The simplest approach would be to just assume that age pension is not taxable. I don't know whether you want to comment on that.
Yeah, that's I guess yeah, that's one thing to do. Yeah, but look, it's a taxable income. That's what the legislation says. Yes, there is this SAPTO. Look, as I said, if you look at this tax schedule, so here you have no tax paid in Australian case, and that's basically, but you get people on full age pension being somewhere here, So yes, they face 19% marginal tax rate, but if you look at the tax actually they pay is minimal. So it's possible. But look, we modeled exactly SAPTO as it is, taking into account differences for couples and singles, all that complexity, and it doesn't do much to the result. So yeah, so that's why sort of if I were presenting that to non-Australian audience, I wouldn't mention it.
Yeah,
doesn't do much.
Yeah.
So
George, it's Ion from the Treasury. Can I just mention something like if you add in the SAPTO and other things, kind of the incentives may look different, slightly different. So kind of like the marginal rates I think at the bottom at the top could be a little bit kind of like.
Yeah, possibly, but just think of this, okay? Here we have the model calibrated to the German economy. So it's as I said, in Australian case, I definitely want to have SAPTO in and other features that sort of we abstracting here from, but maybe, okay? So, all right, thanks.
George,
So
you have one more raised hand from Sasha Wittler.
Yep.
If you want to.
Yep. Hi there, George. Thanks for that so far. That's you've covered some really complicated ideas. Well, I was wondering, and I guess it's a sort of a paired question to John's, but on the wealth side as opposed to the tax side. Is there any? You talked about the difference in average net worth between Germany and Australia. Is there any attempt to include public pension wealth in on either side, in Australia or in Germany, of that wealth figure?
Yeah, good. So look, let me say that for the calibration, we use sort of we try to use common data set where we can compare Germany and Australia, and that's lots of data coming from OECD. And in fact, when we calibrate the model to capture the pension expenditure in Germany, we include public pensions, like public pensions to the public servants, if that's what you mean. And that's also reflected when you look at, for example, like we have the age pension in Australia, but if you look at public pension expenditure to GDP ratio that OECD produces, it's a bit higher than just looking at the age pension, because it includes the public pensions of the public servants as well. I mean, if that's what sort of your question is. So we have that in the model.
No, sorry, I wasn't thinking about pensions for public servants, but actually just pensions in general. Because, I mean, my understanding is that in general, to match the much higher payroll contributions in the contributory system in Germany, most people stand to get a higher public pension than they would in Australia, even though it's not affected by the means.
Yeah, that's matched. I mean, look, I will show you sort of the model calibration, but that's what we do. So basically, what we do here, when we calibrate the model, we target, or we calibrate this CEPAR, this fraction of average to average income in Germany, and you get something that the pension expenditure that's about 56%, something like that, and that's what then gives you pension expenditure to GDP, which in Germany is about, I have it somewhere in the presentation, about 12%. Much higher than what you get in Australia in terms of the age pension expenditure. So that's all in the model. Yeah, that's captured.
I appreciate it on the expenditure side. My question was related to whether it's captured as wealth, but I don't think so. But yeah, thanks for covering that again. Cheers.
Well, yeah, it is captured. You will see. I show you the budget constraint. Anyway, so I go to the model now. Just very quickly, I don't want to spend too much time. It's a stochastic general equilibrium model with overlapping generations. The sectors here includes household, firm, government, and real estate sectors. And we run the model both as closed and small open economy, but main focus is on the closed economy. So the difference between these two scenarios is that in small open economy, factor prices such as interest rate and wage rate are exogenous and unchanged. Okay, so that's in terms of the household sector. So here are the key features. We assume stationary demographic structure with cohort sizes different derived using survival probabilities and population growth rate. Lifespan is uncertain. Household structure, that's sort of this overlapping generations, and we incorporate 3 skill types. So this, in each cohort, there are 3 skill types. You may think of low skill, medium skill, and high skill, and they're based on educational attainment when we estimate the productivity for these skill types. So we use sort of educational attainment. So in terms of labor productivity, that's stochastic and differ by the skill type. So for each skill type of household, we estimate labor productivity over the life cycle. And here in this framework, labor supply is inelastic and retirement is given at the age of 65. We model this main housing tenure decision, whether to become a homeowner or rent. And also there's a consumption saving decisions. So here we also have to distinguish between non-housing and housing consumption in the utility functions. I show you how the sort of utility function looks. So here it is. Agents have preferences over the stream of ordinary consumption and housing consumption to maximize the following lifetime utility. So it's non-separable in these two consumption of Douglas. There is the survival probabilities. So so this is discounted through the survival probabilities and the subjective discount factor. There's interpretable elasticities of substitution and the consumption share parameter. This shouldn't be for leisure here, so that should be for the ordinary consumption here. So that's a mistake here. Also, you should know that here we only included age here. The state index here, or state weight, state vector here, individual state vector, also includes the 3 types of assets: the financial liquid, housing, superannuation, or the retirement asset, or the earnings points in German case. This is the different skill types. This stands for the labor productivity shocks. Okay, so this is the state index before the tenure decision is made. After the tenure decision is made, you also have to have here the tenure status, whether the individual is homeowner or renter. Okay, so I should say here that often what you see in this type of models, there is a parameter here where we multiply the housing consumption or the shelter services derived from housing. And that parameter is greater than 1 for those owning a house, okay? To sort of capture some utility from home ownership. In our framework, we have this parameter basically set to 1. So in the utility functions, the individuals are indifferent between owning a house or renting. But there are other things that sort of drives the home ownership in our model, and we can match the home ownership ratio without this parameter. The other thing I should say is that in the program, we also have the bequest motive here. You can see there's no bequest motive. There are only accidental bequests. But we decided to go without the bequest motive, and that's because in Germany, actually, what you see when you look at how the home ownership rate changes over the life cycle, it actually declines at older age, and also the asset declines at older. And we already have the accidental bequests in the models. They already equate to about 10% of GDP in the benchmark model, which I was told is the number similar to what you observe in Germany. So in this framework, we don't have request model, only accident. And here is the expected lifetime utility. And really here, this is to address this such points about whether the asset already includes the pension. Yes, it includes. So here, what you can see, here you have the total savings or total wealth, okay? And that's equal to, so to the liquid asset. These are the mortgages minus the mortgage. This is plus the superannuation in Australian case. This stands for the labor income, the gross labor income. There are these bequest receipts, so this accidental bequests, and they are redistributed to surviving generations. So this is the housing asset. Here we have the public pension. This is the contributions to pension system. That's the income tax, and this is minus the consumption expenditure that includes the consumption tax rate. And if the individual is renter, then sort of they also have to pay rent. Now, of course, so individuals also making these decisions whether to buy a house. If they decide to buy a house, they face restrictions. They face restrictions to households, minimum household size, house size. They also face restrictions how much they can borrow. So there is a loan to value ratio. And also they face transaction costs. So they have to pay transaction costs when buying the house, which in our framework also includes the tax that those buying they have to pay, and other transaction costs, to agents when selling the house and so on. So the rest of the model, as I said, I didn't want to spend too much time here. We have production sector, perfectly competitive profit maximizing firm that demands capital labor to produce output. The government sector, there we assume, when we change the policy, we assume that consumption tax rate adjusts to balance the budget. Now, in Germany, okay, there are basically two budget constraints. One is the government budget constraint. The other one is the pension budget constraint. And sort of here you can see the tau P is calculated to fund the current pensions of retirees. In Australia, the age pension is included in the government budget constraint, and this tau P is basically set zero here. It becomes contribution to superannuation rather than payroll tax. There's real estate and rental markets. In our framework, I should say house price is normalized to 1, and housing supply is completely elastic. So we don't have capital gains on owner-occupied housing. But the plan for the Australian model is to capture also the short-run implications, and there we plan to sort of address this restriction, okay, and make the house price endogenous. And the supply of rental housing, that's standard modeled by this two-period rental agency that sort of provide rental housing. And then sort of you get endogenous rent, basically. That depends on the interest rate and the depreciation rate of owner-occupied of rental housing. Now, similar to other models, market clearing condition has to be satisfied. So here I'm showing the goods market clearance. Now, compared to model without housing, here you also have to have investment into owner-occupied housing and rental housing and the transaction cost. So that's the model. Is there any questions? If